Stocks gain with the benchmark Nifty stamping 24,000 after foreign investor buying last week. Energy and power stocks are the biggest gainers, even as FMCG is a big drag. The Nifty Bank has hit a record high and continues to build on that. The mid caps are outperforming as well.
Private heavyweights, HDFC Bank, ICICI Bank, power up banking stocks after beating profit estimates in the fourth quarter. Good deposit growth, pristine asset quality and healthy margins underscore a strong show.
Infosys misses Q4 expectations but guides for revenue to grow at 0 to 3% ahead of most analysts' expectations, powering up IT stocks. Valuation comfort adds fuel to the up move.
Eversource Capital may be in advanced stocks to buy beleaguered ride-hailing player Blue Smart, a deal that will likely involve the promoters Jaggi brothers stepping down.
US Vice President J.D. Vance arrives in India even as bilateral trade talks are expected to have made good progress. Experts believe talks between Vance and PM Modi will extend beyond trade to other strategic issues. You're watching Halftime Report live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia. With me is Mangalam Malu, and it's a very good halftime report that we are bringing to you from the market's perspective. The Nifty back above 24,000, in fact above 24,100 now. The Nifty Bank making new highs. The Sensex is up 1,000 points. Well, what more could you ask for after coming back from a long weekend?
What more could you ask for from a long weekend? You know what's interesting is that the way Mumbai played against CSK yesterday, the single-handed win that our boys gave us is exactly what's taking place in the markets today, and the bulls are concerned. Because what is it that Mumbai did to CSK? You had the top two players do extremely well. We had the erstwhile giants like Rohit Sharma as well as Surya Kumar Yadav powering Mumbai ahead in a win which was 9 wickets more than, or it was a win which was with 9 wickets. So thumping victory is what we saw there. That's exactly what's taking place in the markets right now. We've been talking about how the Nifty Bank will do a lot better in today's trading session, hit a fresh record high. Well, come the second player, we have the IT index as well. After so much disappointment, maybe the street believes that we have a bit of a value zone in space and in place, as a result of which we've seen the index move ahead. So the Nifty Bank was always expected to support. The IT pack is the one which is leading or lending that additional push to the frontline index, and as a result of which the bulls are thumping ahead right now, near 300 points on the Nifty. Speaking about IT, we have to go to Rima. Rima, it has all started with the performance that Infosys made this morning in terms of the stock price, even though the company missed the fourth quarter performance. What do you make of this?
Well, as you rightly pointed out, Q4 was a miss. The FY23 guidance at first look at 0 to 3%, you would say is lower than consensus expectation. But what the street was fearing perhaps was a lot worse. So look at what JP Morgan has to say about the FY26 guidance. They say it's below prior expectations, which was set 3 weeks ago. But it's better than the recently feared post-tariffs and the uncertainty impact flagged off by Wipro's print. Remember what Wipro guided for Q1. Citi too says the guidance looks decent in the current backdrop, though the higher end does look a little aggressive to achieve. But don't forget, the Q4 was a miss. The company's top line declined by a sharp 3.5%, though margin performance was a saving grace. But many brokerages, in fact, 70 to 80% of the brokerages have a bullish view on Infosys. Many of them have it as a top pick. So Kotak says they expect a muted performance in FY26 on account of the uncertainty. And considering that Infosys has a higher exposure to discretionary spending, it makes Infosys more vulnerable than the other peers. But given the company's strong positioning in cost takeout deals, basically cost optimization in the phase, vendor consolidation and AI, they believe the company will be able to weather the storm. They have a buy target price 1,700, lower compared to the 1,800 that they had before. Jefferies buy call 1,660, JP Morgan overweight call target price 1,800, HSBC target price cut, but it still stands at 1,700, and similarly for Nuvama too.
Well, if HDFC Bank and ICICI Bank could be categorized as boys played well, Infosys has joined the party as well. But what's also on the list is Tata Elxsi has reversed not only all of its morning losses, but it's now up almost 9%. Rima, what has the quarter gone by for Elxsi?
Well, you know, the quarter undoubtedly was weak. It was lower than street expectations. It was the third consecutive quarter of a miss. Revenues for the company declined by 5.3% quarter on quarter. EBITDA margins sharply lower at 22.9%. Profits declined by 13.5%. So what could be driving the stock higher? Well, it could be the management commentary, because what the management said in the conference call is that they expect growth stability to return in Q1. FY26 should be better than FY25. Analysts say, well, this looks difficult to achieve, but the company is calling that out, and they're expressing their confidence based on the deal wins that they have. Remember, the company also in Q4 announced large deal wins, a $100 million deal win in media and communication, and about a €50 million deal in the transportation vertical. Also, the stock has seen a big derating. In fact, in the last 3 years, it's a negative return of 35%. So the stock has been under pressure. So these could be some of the factors that maybe tactically there is, just going by what the management has to say, maybe the worst is in the price. The stock is looking attractive at these levels, but brokerages are still a bit cautious. Kotak and Ambit have a sell call with a target price at about 4,000, 4,500, which is lower than the current market price.
All right, we take that point. Rima, thanks a lot for that. We have the IT pack covered. Now let's talk about some of the city gas distribution companies. The government is taking measures for sustained allocation of affordable gas to them. Sudarshan joins in with more details on this development. Sudarshan, this was largely on expected lines, but this is still nevertheless a positive.
It's a minor positive because over the weekend we have seen that government has announced some changes to the domestic gas allocation, and this time domestic gas would not only include APM but would also include new well gas. So what does government say? It says that from Q1 of FY26, domestic gas allocations will be done on a 2-quarter advance basis. So currently it's done per quarter, but now from Q1 of FY26 it will be done in the advance of 2 quarters. And second, apart from APM, new well gas will also be part of the allocations. Now, for new well gas, as of now, it used to be done via auction, but now it would be done via pro rata. What does pro rata mean? It would be done as per the demand. Suppose that if, for example, the MGL and IGL, if IGL has more demand, so IGL would get more new well gas than MGL. Now, third, as per the government, allocation as of Q3 FY26 was 54.7% of total demand. And even in Q1, it's around 55.7%, and Q2 FY26 also government expects to be around 54.74%. But this 54.74% includes both APM and new well gas, because as per the communication we received from IGL and MGL, APM is around 37 to 38%, and new well gas will form around 17 to 18%. What do analysts say? Analysts believe that it's not sure if there will be further decline in the affordable gas, even from current levels as well. But what is positive is we are saying crude is soft, even this LNG prices are soft. These soft prices will help companies to maintain the margin, not only in the near term, even because there are expectations that even going forward over 12 to 18 months, these prices are going to remain soft. So that would aid the margin for most of the city gas companies. And today's trade, on the back of announcement from the government, you are seeing positive move in these names.
Positive moves indeed. Sudarshan, thanks a lot for that. By the way, the Nifty is still up 280 points, 24,130 on the index. Some of the top movers then, Just Dial, also another earnings reaction, is now up 11%. Suzlon has also extended its gains after that notification that came in from the Renewable Energies Ministry. That stock too is up over 7%, now 6.5% higher for Suzlon. We'll talk about all of these buzzing names on the other side of this short break. Stay tuned, we'll be right back. Welcome back. Onto some buzzing stocks in today's trading session, one of which is Eternal. That is also trading with gains of around 2.5%. And that is after the company made an announcement last week that it will cap its foreign shareholding at 49.5%. Now, what does that mean for the stock? How are brokerages looking at it? Mangalam will tell us about all of that. Mangalam.
Well, Eternal, erstwhile Zomato, has approached shareholders to for an approval to cap foreign shareholding to 49.5%. What this means is that domestic holding of the company would be 50.5%. Is this new? Not necessarily, because the board approval has come by. Remember, the company has already raised funds, via a QIP itself from domestic investors. So the shareholding is more domestic than foreign. The management has indicated that as well. The shareholder vote is via remote e-voting between 20th April to 19th May. And this will maintain Indian ownership classification for the company. Why is this important? Because in the long term, there could be potential regulatory risks around foreign ownership in multi-brand retail. There are, foreign investors who are, or foreign companies who are not allowed to do a lot of things in the retail business in India itself when it comes to multi-brand. One of that is stocking your own inventory. So you're allowed a marketplace, not allowed to stock your own inventory itself. So this protects the company from any long-term risks around that. But in the near term, because it is a domestically owned company, there could be a risk of outflow from passive indices, exclusion from passive indices like the MSCI in the near term. Analysts expect a near $1 billion outflow as well whenever that happens, either in the current the current renovation or the next check of the MSCI index itself. What is it that brokers are saying? ICICI Securities says that foreign shareholding cap supports the shift to owned inventory model. It will add about 100 to 150 basis points EBITDA margin in the quick commerce segment, for which they will have to deploy around 1,000 to 2,000 crore in terms of working capital, because they will have their own inventory right now. But can they do that? Of course, yes, because they have cash of nearly 19,000 crores, which the company had said that they're raising for QIP for that very reason. Morgan Stanley has an overweight call as well. They're saying that this will enhance their moat of quick commerce, but increase capital intensity, which may be offset by margin expansion itself. Jefferies as well as CLSA, both of them positive on the stock. Jefferies has a target price of 255. CLSA has an high conviction outperform call with a target price at 375. But the near-term headwind still remains, which is that of nearly $1 billion worth outflows whenever the index reconstitution happens for the MSCI.
Interesting. And even after the stock corrected significantly from its peak, which was around 304 rupees, the stock managed to defend that mark of 200 on the downside and has seen a rebound from those levels. Now at 232 is eternal. Well, focusing on Angel One now, as the fourth quarter was a weak one for the company, a sequential decline across the board, across all parameters. The management also told CNBC-TV18 earlier that FY26 will be a year of consolidation. Now, Mangalam, you will tell us more on our special segment, Insight Edge, as to what were some of the key takeaways that you had with the management.
Well, the reason why the stock has moved higher is because now the management, by virtue of its conversation on CNBC-TV18 and in the conference call as well, did indicate that the worst was definitely behind the capital market players. Why do they say that? Because one, it was a perfect storm. There was a fair amount of volatility in the stock market. There were also a lot of regulatory changes, which now the street believes that is gone and done with. There are signs of recovery. The impact of regulatory changes have been absorbed by retail investors. The revenue curve is moving up slowly. They said February was the trough. Thereafter, there was some recovery in March, and that continues into April as well. And this revenue increase will contribute directly to margin improvement. There were a couple of one-offs in the fourth quarter as well. If you take note of that, going forward, margins are likely to improve. They saw 6 to 7% month-on-month growth in F&O orders in the last 2 months as well. F&O was largely hit by the regulatory segment. And they say that while FY26 will be a year of consolidation, some of their products like Wealth doing well, seasonal market share changes that they saw in the commodities and F&O business as well. And they said that they are able to bounce back to their 44 to 45% operating margin guidance by the fourth quarter of FY26 itself. So were that to happen, then maybe a lot of the estimates that the street was making of a large single-digit decline in EPS for FY26 may not come by, because if the margins are improving, even if the revenue stays stable and the worst is behind, then maybe the performance would be slightly better than what the street is fearing. Add to all of this, the stock is in F&O ban. So no fresh positions can be taken to be carried overnight. Though, can the stock get out of F&O ban or not? For that, you'll have to take that break, come back, talk about the F&O segment, and that's when I tell you whether Angel One comes out of F&O ban or not. But as of now, from a business standpoint, the management says perhaps the worst is behind. So let's listen into what Dinesh Thakkar, who's the CMD of the company, who had to say about the business.
Macros, be it our economic growth, be it FIS not investing, and majority impact is because of regulatory changes, which has now, I would say, absorbed by retail investors. We saw a bottom in terms of number of orders in Feb. We did almost below 50 lakh order per day, which is kind of like minimum. After that, we are seeing slowly kind of like revenue curve is moving up. So March numbers were better in terms of 53, 54 lakh order per day. And we are seeing this trend continuing in the like this month also. So that gives me confidence that, okay, at least revenues are now, revenue come has turned for better. So whatever revenue increment we see in this progressive months, that will straight away contribute to our expansion of margin. Whatever impact we have seen in terms of F&O order, on month basis, I am seeing a growth of around 6 to 7% now for this past 2 months. So that gives a broad sense that, okay, retail are coming back. See, for retail, there was no reason for them to come back because markets were depressed. They did not see any opportunity and they were not in a hurry to really jump and decide that what kind of an instrument they had to buy, if at all not options. So what I am saying, after this kind of like stabilization in terms of our kind of like news that are coming and FIs inflows that are coming in, it appears that retail is getting back confidence to come back to the market. FY26 this year would be a year of consolidation where we would be focusing more on getting back to OPM, and the growth is going to help. So currently we are not working on what kind of a top line we will achieve because it's a function of market condition, lots of things. Internally, what we can do is that, okay, how do we bring in AI tool, get more cost efficiency, and how do we bring in more customer on our platform? So result of that, whatever revenue we are going to get, it is very difficult to predict at this point in time. But what we are confident is that we would be able to bounce back to an OPM of 40-45% by Q4 FY26.
Well, the worst is over, is what Dinesh Thakkar of Angel One says, and it's showing up on the stock as well. 6% higher now for the stock at the highest point of the day is Angel One, but of course significantly away from its all-time high, which is close to around 4,000 rupees. We take a short break. The Nifty is now up 320 points, up at 24,160. The Nifty Sensex is now up almost 1,000. We'll get you more with a chart check with Sudeep Shah of SBI Securities, and of course, Mangalam tells us whether Angel One comes out of the F&O ban or not. Stay tuned.
Welcome back. You're watching us here on Halftime Report. Perfect time to get you up to speed with what's taking place in the F&O space. First things first, no questions about it. Bulls have charged ahead. The Nifty up 311 points. When we started the show, it was 280 points. When we started the previous show, it was up 200 points. So at any point in today's trading session, had you bought, you would be in the money. That's the kind of trend day that we've seen. Nifty Bank continues to do well. The mid-cap index a shade better at around 2.5% in gains. The Nifty accelerated its up move once it crossed past the 200-day moving average of 24,050. Now the level to watch would be the 2025 high of 24,227, from which we are just about 50-60 points away. So were the Nifty to cross that 24,227 mark, it would make the Nifty, at the highest level of this calendar year itself. What's interesting is the tug of war that took place between the Nifty Bank and the Nifty IT over the last 1 month. Over the last 1 month, the Nifty Bank is up 7.5%. The IT index is down 8%. So the outperformance of the Nifty Bank is nearly 15%. Now that is coming undone. Can it go past, a lot more from here on itself or not? Because the Nifty Bank is at a record high. The Nifty is still 8% away. The Nifty IT is 26% away and Reliance is 19% away. Nifty IT and Reliance, if they make a move towards that 52-week high from current levels, if these stocks or sectors have bottomed out, then who's to say that the Nifty may not cross a record high, which is about 8% away. Quite a lot, but still a marker to keep in mind. What's also important is this week, the momentum is firmly with the bulls. And this week is important from a momentum standpoint because it's April series expiry. Nifty is up 2% in April series this week, but from April series low itself, we're up around 11 to 12%. Where do we go from here? For this expiry, the 24,000 mark seems like a foregone conclusion because the put writers are fairly active there. 24,000 now an important psychological support, as is the 200-day moving average, which is at 2450 itself. 23,900 put writers also making a lot of money right now by writing that. On the way up, the 24,200 call writers and the 24,300 call writers are taking their chances, believing that maybe around 24,350 and 24,300, there could be some sort of supply that may come by. If that were to happen, then these call writers would make money. But if that weren't to happen, then these call writers will have to cover their positions. That may cause another melt up towards that 24,500 mark. A couple of stocks that I'm keeping on my radar. Nalco may exit F&O ban in today's trading session. And Angel One, we spoke about how it entered the F&O ban in the previous trading session. But with the kind of up move that we've seen in the stock and the concomitant pace at which the open interest has declined, it stands at around 83-84% of market-wide position limits. If it falls below 80%, the stock exits F&O band. Remember, in the previous trading session, it was at around that 97% mark. So in the first half of trade itself, it's come down by about 11 percentage points. Who's to say, again, in the next 3 hours, if it goes beyond, goes lower by another 300, 400 basis points, then it may actually come out of F&O ban. Chances are that it may well come out of F&O ban today.
We're hoping for that, a lot of those bulls. But yes, 6% higher on Angel One, and Nalco 2 may exit the F&O ban in today's session. But Sudeep Shah of SBI Securities is joining in now on the show. Sudeep, good afternoon. Thank you for joining in. We have had 3 consecutive days now of very, very strong moves on the index from defending levels of 23,000. We are now well above 24,000. Where do we go from here? And does Nifty Bank have more upside in store after the kind of moves you've seen today? And couple that up with your stock recommendations as well.
Afternoon, Hormaz and Mangalam. See, I very well agree with Mangalam that every passing hour we are seeing the rally getting strengthened. And what we feel is that with the indices crossing the 200 DMA today and with such a force, we are more likely to head towards 24,400, 24,500 on Nifty in the next couple of days, probably ahead of expiry. On the downside now, the way the recent resistances have been taken out, which is closer to 23,800, 24,000 now. So we feel on the downside, 23,900 now becomes all the more important support. So till the time 23,900, 23,950 holds, this rally could extend up to 24,500 and above. And from the Bank Nifty standpoint, kind of rally that has already happened ahead of the results of ICICI Bank and this in the last weekend, and the strength which is being visible today, we feel that now it's in an uncharted territory, and till the time 54,800, 55,000 holds, Bank Nifty is poised to go towards 56,300, 56,700. And it's just gaining strength by strength. And now with the large caps, even the mid-sized bank as well as the PSU banks are participating. That gives all the more strength to the banking space.
What about specific stocks, Sudeep?
Hormaz, there are 2 stocks on my radar. One is the first one is MCX. Now, in case of MCX and all these platform stocks as well as the financials stocks which are related to the financial market intermediaries, here there is a decent pullback on that has been witnessed in the last couple of weeks. And we feel MCX, which has now crossed above its February and March swing highs, is poised towards 6,200, 6,300 in the coming few weeks. And this can be bought with a stop loss of 5,700 on the downside. The second stock which is on our radar is CDSL. Now, similarly, CDSL also has a similar pattern. It is reversing from lower levels, strong pullback which has been witnessed in the last several sessions. So this could be bought with a stop loss of 1,260 on the downside and a target of 1,360 and 1,400 on the upside.
All right, we take that point, Sudeep. Thank you so much for joining in and giving us your view on the market. Nifty gaining with accelerating volumes and a lot more gusto. Take a short break, come back on the focus on banks once again on the back of their fourth quarter earnings and what this means for all the others which are buzzing around as well. On the top of the list are HDFC Bank and ICICI Bank.
Welcome back. 1,120 points higher now on the Nifty Bank, well above the 55,400 mark, a new record high today for the index, and of course led by the heavyweights HDFC Bank and ICICI Bank, which are powering along, both of them at record highs as well, and these after reporting their fourth quarter results. Abhishek is here to decode how they fared in the fourth quarter.
With respect to ICICI Bank, the loan growth momentum is weak. However, the PNL is very strong for them. Versus our poll, the NI and PAT is a beat on our poll. Deposit growth came in at 14% YOY and about 6% sequentially. YOY, it's one of the weakest growth that you are seeing in last 8 quarters. Now, advances growth were on the lower side at just 13.3% YOY and 2.1% quarter on quarter. So YOY, it's the weakest growth that you are seeing in last 17 quarters, and sequentially, that is quarter on quarter, you are seeing one of the weakest growth that is coming in 15 quarters. Net interest margin is at 5-quarter high of 4.41%. Core operating profit growth is at 5-quarter high of 13.7%. Now, quarterly annualized slippage ratio is at 17-quarter low of 1.5% versus 1.85% in the previous quarter. Their asset quality continues to show robust decline and is one of the best in last 10 years or even more for them. Gross NPA ratio and net NPA ratio have improved, with ROA or return on asset being the highest ever that they have recorded, north of 2.5% in this quarter. Back to you.
All right, we take that point. Abhishek, thanks a lot for that. Let's hear out what the management had to say in their post-earnings conference call over the weekend.
So as far as the loan growth is concerned, I don't think anything specific incrementally in terms of caution on the credit side. I think we are pretty comfortable with what we are underwriting. Of course, on personal loans and cards, as you know, we had tightened, a few quarters ago, and that is showing up in the volumes over the last couple of quarters and the loan growth. But other than that, no specific caution on the credit side. I would say it's largely a function of what is happening in the system. And also, I guess, on the pricing side, some consciousness given that, during this quarter, we were at the sort of cusp of the, downward movement in benchmark rates. We have seen liquidity improve substantially over the last couple of months with all the measures that the central bank has taken. And deposit growth for us has continued to be quite strong. You would have seen the numbers for the fourth quarter have also been pretty strong for us. So, and as the rate, now, of course, if you look at it, the repo rate has fallen by 50 bips. So that will start to see a transmission into deposit rates, which is what has started. So I think that's, in the natural course of things.
It was a strong quarter for HDFC Bank as well, and CEO Shashidhar Jagdishan also commented about how the bank will place itself among global macro uncertainty and its plans with the key ratios in the upcoming financial cycle. Listen.
We've already seen 2 rate cuts, and the change in stance from neutral to accommodative is a welcome relief to all of us. RBI intends to increase durable liquidity, which is followed by concrete actions, which along with rate cuts will help supporting the GDP growth. For FY26, we expect the GDP to be supported by a pickup in rural spending, discretionary consumer demand, and investment activity. Of course, the goods exports may be impacted until the global trade and tariff situation becomes far more clearer. We acknowledge that the global macroeconomic outlook has become more uncertain due to the recent trade tariff-related measures and the volatility surrounding them. This may potentially impact global inflation, leading to lower growth across economies. Corporates have adopted a wait-and-watch stance, and we are waiting for more clarity. We remain watchful. Our credit deposit ratio has been brought down from the highs at the time of merger, which was at about 110%, to around 96% as of March 2025. Our deposits have grown faster than the system, and so has it grown faster than our loans as well. Next year, in line with what we had committed, the adjustment in CD ratio will not be so steep, supporting the loan growth for the bank, but it will be on a downward path. Asset quality, one of our USPs, remains pristine. As liquidity and growth improve, we are well placed to grow in both assets and deposits.
Right, the stock which is doing well right now is Power Grid, moved to the high point of trade. And we're also seeing some traction in names like Titan, which has recovered from the lows even as gold continues to shine. We have Muthoot Finance at the bottom of your screen announcing an interim dividend of close to 26 rupees per share for FY25, which currently implies about 1% in terms of dividend yield. Stock doing a lot better because of the rise in gold prices and perhaps the recovery from the lows that we've seen in the stock already, which has seen a decline of almost 7.5% in 1 month. Take a short break, come back, focus on a bunch of stocks which are in the news.
Welcome back. Just to put a look at some of the other movers on the Nifty 500 in today's trading session. We did speak of Suzlon earlier on the show, but Aavas Financiers has made a move in the last few minutes, 7.5% higher there as well. Anant Raj is one of them as well. Anant Raj will be reporting results today, so 7% higher on that stock as well. KFin Tech is up another 6.5%. Nippon AMC. So most of these capital market plays, be it Nippon AMC, HDFC AMC, all of them doing well in today's trading session. What's also doing well is Divi's Laboratories, and as that's because the company has signed a long-term supply agreement with a global pharma firm. Vinny is joining in with more details on that. Vinny.
Yes, good afternoon. So you're keeping an eye out on Divi's Laboratories. Like you mentioned, long-term supply agreement is what they've signed with the global pharma company. This agreement is mainly on going to be focusing on manufacturing as well as supply of advanced intermediaries. And this is in the custom synthesis side of the business. Now, custom synthesis, when you look at it in Q3, accounted to around 53% of their revenue contribution, saw growth of around 44% as well on a year-on-year basis. And that is why, we're expecting this to support the growth of the company going forward as well. This is expanding their portfolio on the custom synthesis side. The company is planning to invest around 650 to 700 crore rupees for capacity expansion because of this new client that they've added as well. Net cash on the books as of 31st December was around 3,600 crores. So not much of a worry on that front. The company will be increasing their capex plans or focusing on capex plans through internal accruals as well. And a good deal that is coming in for the company in terms of revenue contribution, that will see an improvement as well. And significant meaningful revenue is what is expected from this company going forward.
Vinny, thank you so much for that. Let's talk about the oil and gas space now, more specifically the city gas distributors. The oil and gas regulator, PNGRB, has floated a consultation paper for review of the natural gas pipeline tariffs. Sudarshan joins in to tell us more on this, the stocks that get impacted and what brokerages are making of this. Sudarshan.
So this is especially for GAIL pipelines. GAIL currently has 10 pipelines. So over the weekend, we have seen that PNGRB, that is the regulatory body, has released the consultation paper related to the tariff hike that has been long pending. Now all the stakeholders have to reply to GAIL by May 1st, and GAIL has to reply by May 15th to PNGRB. And following that, PNGRB will have the open discussion and the board meeting to approve the tariff hike if there is any that we can see, and that can come in the month of June. So what was the GAIL's submission? GAIL had proposed the tariff to increase from current level of rupees 58 per MMBTU to rupees 78 or more than rupees 78. But after the certain queries from PNGRB, the proposed increase was seen at rupees 77.43. Last month, we had a conversation with GAIL, and which GAIL had confirmed that it had proposed a hike to rupees 78. But even if the increase comes around rupees 70, that can also be taken positively. Now today CLSA has written on that it has upgraded the stock to outperform from hold, and target is increased to rupees 210 from rupees 175 per share. It has even increased EPS estimates in the range of 9 to 19% because it believes that tariff hike can come, and that can be in the range of 20 to 25%. That will be positive for GAIL because this tariff hike has been long pending and GAIL has been demanding for the last few months, or say basically last 1 or 2 years. And GAIL had also said that if the tariff hike can come, it can be implemented retrospectively, because once it's done, that would be effective January 1 to 25 to 2049, because economic life cycle of a pipeline is seen as 30 years. That's the reason it will be implemented for 30 years. So overall, it's very positive for GAIL.
Very positive for GAIL, showing up on the screen as well, 4.5% higher. Sudarshan, thanks a lot for that. Well, JSW Energy will be setting up its largest greenfield thermal power plant with a capacity of 1,600 megawatts in West Bengal. CNBC-TV18's Abhimanyu Sharma caught up with Sharad Mahindra, who is the joint managing director and CEO of the company, to understand the scope of the project, and also asked him about the company's plans to set up a green hydrogen plant in Karnataka. Listen to what he had to say.
We are at a very advanced stage of commissioning the first such project, though not very big in size, but still largest in the country, and which is which is a part of the PLI scheme, where we qualified also, which is the 3,800 tons of green hydrogen coupled with 30,000 tons of green oxygen. We are going to commission this project in the current quarter, which is Q1 of FY26. And which we are supplying to our captive requirement to JSW Steel, and it's a co-located plant in Vijayanagar in the state of Karnataka.
Also about renewable energy targets, about expansion in the renewable energy sector, there are several issues which still exist as concerns, be it pump storage, be it the foray of the private sector into nuclear energy, and also with respect to a replacement of the base load with renewable energy. Now, these continue to be big concerns, big elephants in the room, as not just your company, many others in the ecosystem are also driving the foray. What are the deliverables you are looking at while you try to solve these issues?
Yeah, this is very pertinent question, I'll say, because as I said, the demand growth, the way the demand growth is happening, even a conservative demand growth of 5.5%, 6% growth, the amount of energy every year which is required, like last year approximately, country consumed 1,700 billion units of power. And even if we take a conservative 5.5%, 6%, which is going to be a number of almost maybe 125 to 130 billion units incremental will be required, which when converted into capacities will be about 25 to 30 gigawatt of fresh capacity. Assuming that maybe 7, 8 gigawatt or even 10 gigawatt on a very higher thermal capacity gets added. So balance 15 to 20 gigawatt through renewable energy, where the PLFs are 30%, if you say wind or solar combination, the capacity addition in RE space which is required for wind solar is close to about 40-45 gigawatt. This is the size of opportunity which country is India exists. So we are cautious in terms of where to go. As I said, that our some of the basic principles are that my returns to my stakeholders, my shareholders is protected, financial prudence is maintained, the benchmark ratios which define my ratings, which give me an advantage in terms of the interest rates which the banks and financial institutions offer. All those things are paramount for us. Keeping all those things in mind, we have made the plan. But of course, round the clock storage power and other things, that is evolving now. Initially it was battery energy storage. Now Government of India in last budget announced pump storage policy, and a lot of pump storage bids have come. We have also won. We have signed the power purchase agreement. So a mix of solar, wind storage, either through battery or pump storage, is going to be the future.
Two aspects you spoke on, be it PPAs or a transmission system, both are important cogs in the wheel, important linchpins for energy security moving ahead. What are your plans for PPAs in other states? And also a comment on the transmission system. Of course, the government has been working overtime. Several states have also been making efforts in this direction. What are the kind of deliverables, the kind of targets you're looking at in the transmission system, and also with respect to PPAs?
Yeah. See, PPA, as I said, that operational 12.2 gigawatt today and another 18 gigawatt capacity, for which either the PPAs have been signed or we have received the letter of award, wherein some portion the PPAs are to be signed. So we are definitely focusing, as and when the states keep on coming with their requirements, we have the letter of award awarded through either SECI or SJVN or NTPC bids. So states, as and when come, we are ready with the solution. It is only the question when the state comes for signing the PP. So our teams are engaged with them, but we have enough signed PPAs to take care for next few years, on which we are working.
The management of JSW Energy there. But moving on, cash flows are important, but not everything. That's the view from emerging market investing expert Prashant Khemka. Now, in the latest episode of Market Cafe, Khemka shares his investing lessons from the 90s .com era with Surabhi Upadhyay and explains why he chose to invest in new age stocks like Zomato, even when they were making losses. Listen in.
Today, I often get asked, because we are very cash flow centric and there are loss making companies in our portfolio as well. So how do you talk about superior returns on capital for a loss-making company? Yeah. Some of the new age companies that our team very much likes and owns for several years. So it is superior returns on incremental capital. Looking forward many years, people take this lightly, but value of any business is present value of future cash flows. It's not necessary you have to make cash flows in year 1, year 2, or even year 3. Whether the cash flows that you are expecting over time,
I remember this categorically because I remember doing a show when Zomato was listing with some of your team members, and there was a massive debate there about whether this whole price to sales, there's no earnings, how can you value a company like that? And of course, White Oak took early calls, big believers early on.
Absolutely, and we've owned, its parent company since much longer, ascribing value to these investments that the parent company has made. This is one of the lessons I learned, I would say, early in the TMT bubble, .com bubble, when in my US portfolio, I never could buy Amazon.
Okay.
Thinking that it's not making money. And at that time, it was also an assessment that it can never make money. I did own telecom companies or wireless companies which weren't making money. But I guess in wireless companies, it was very well accepted that for several years, they would make cash losses at least. And then later on, they'll generate cash flow. But new age companies, because there isn't an established business model to look back onto, people often just ignore them or write them off as something they won't look at. And that's the opportunity for investors like us who are willing to take a closer look.
We've reached that point again for these new age internet stocks where the debate is back on. They're investing a lot in dark stores, they're expanding in tier 2, tier 3. So suddenly some of them are saying that they reach profitability, but maybe, at least in quick commerce, it can get delayed because of this expansion.
Yes.
What do you think about these businesses as of now?
See, the same way we've looked at these businesses, there'll be winners and losers. Not everyone's going to be, the next whatever of India. See, we do benefit having invested during the .com bubble through the late 90s and 2000s in US, where these kind of companies first came to market. Having made mistakes there, both of commission and omission. Amazon is a mistake of omission, if you will.
Missed opportunities.
Missed opportunity. Then as on the EM, while in India, a lot of these businesses might be developing for the first time. That's not true globally. In China, this story has played out a decade ago, right? The Alibabas, the Meituans, the Tencents, those all also have had the opportunity to participate in several of them in the IPO. Just like Google in US was an IPO company invested in my portfolio. Similarly, Alibaba and others were IPO companies. In Korea, you have similar companies who are leaders. They're just further along in the journey to profitability than some of the Indian companies are.
Right.
And if you study the US, the developed markets, the emerging market companies in similar businesses, how they've progressed, how they now have come to a stage where they are throwing up tens of billions of dollars of cash flow. The Mag 7, there's a cult-like following amongst Indian investors for the FANG. FANG was very widely followed 2 years ago.
Absolutely.
Majority of those FANG companies weren't making money or cash flows
when they started
when they were $100 billion in market cap or more. Obviously Microsoft was making money and some others might have been making money. Google was making money early on, but others, Amazon wasn't making money, Netflix wasn't making money, yet they were so loved.
Sure.
So
you have to be a patient investor if you're going to be on
patient and selective. You can't have a spray and pray approach across all. Not everything would become a Amazon or a Facebook or something.
Absolutely.
Interesting conversation there. What we'll do is take short breaks and come back. This time around, we'll have Manisha joining in with Sanjay Kumar, who's the MD and CEO of Resence, to talk about all things commodities.
Welcome back, and joining us on the show now is Sanjay Kumar. He's MD and CEO at Rastan. Sanjay, hi, thank you so much for joining in. And it's been a volatile market for across sector, across companies and segments as well. When it comes to food, really, we're looking at very volatile prices in the global markets. India, of course, has seen slightly easing off inflation here. But what has been your sense, whether it's about weather, Indian production or the global cues? What is it that you're watching at?
Hi, Prakash. Thank you for this call. The way I see it, we have to look at both the supply side and the demand side. So the good news is that this year, the FCI expects to hold almost 30% more stocks than it did previous year. So about 32 million tons is what we expect. We also expect that retail inflation will be moderate, driven by lower oil prices. But what we need to watch is, and which is a very interesting trend, is that domestic food consumption has been increasing, particularly in the rural areas. Over the last 12 months, it's up from almost 3,700 per capita to 4,200. So even as we produce more food, stock more food in the warehouses, which helps stabilize inflation, we must make sure that we are able to meet demand. And if demand grows at a faster pace than what we see in terms of the reserve buildup, we could see a spike in inflation.
And what are your concern areas within here? Because when you look at rice, there's record production. Wheat as well, after 2 or 3 years of concerning situation, we've seen some stability come there. Edible oil, well, yes, that can be a bit of an issue. And where do you see major concerns coming from?
So you rightly mentioned wheat, I think, is going to be pretty stable. There's 12 million tons additional this year that we expect in the reserves. So that will have a moderating impact. Where we still see a concern is pulses, actually, because, given what we are seeing in Canada and the unstable global environment, we'll need to watch that. We'll also need to watch oil, particularly, in the backdrop of the recent deal that we've seen between Malaysia and US with regard to palm oil. So overall, we maintain and we believe that this year will be less inflationary than last year was. As you remember, last year was one of the worst we've seen for food inflation. So to that extent, it's definitely good that we have 105% above average monsoon forecast. So food production is going to be stable. On the back of good infrastructure, we expect that movement of food within India will be less expensive, which will enable to pass on some of the surplus production which happens across different regions to harvest the benefit from that. So our view, coming back to your question, remains that this year will definitely be better than last year in terms of overall food inflation as well as retail inflation. And that's good news.
Oh, it is. Sanjay, so how good is this time to be in food business as you are? You said rural consumption seems to be increasing. What about urban and the changing trends, etc.? What does it mean for you?
Yeah, so from a business standpoint, we maintain that the food services business will grow at about 16%, which makes India one of the fastest growing market. It also provides a great opportunity for Indian companies to now start investing for the future, because Indian companies have largely shied away from this sector, even though it's almost $20 billion. We're still waiting that moment in history when the first Indian food service company will list on the Indian stock market. We are the only country in the world which doesn't have a listed food service company. So our expectation is that on the back of manufacturing growth, our business per se will see between 14 to 16% growth in revenue. Margins, we believe, will remain depressed, largely because of the fact that input tax credit is still not available to the food services business. Should that get restored, we will see some margin enhancement. But in the near term, I expect that revenue growth will be quite robust, far outstripping what you would see anywhere else in the world.
Thank you so much, Manisha, for taking us with this conversation. A big up move is what you're seeing in the market. Once again, the Nifty closing in on the 24,200 mark with a 330-point gain, 1150 points on the Nifty Bank now. Take a short break, come back on the other side. Business Lunch takes all the market action ahead.